Container freight rates on the Asia to Europe corridor have increased 312% in 14 months. This shift operates via the structural reallocation of blue water tonnage away from the Suez Canal, compounding container scarcity across primary trade lanes. For global distribution networks, this structural pivot elevates localized operating expenses, driving persistent baseline input costs across major consumer categories. Macro Frontier tracks the reallocation of physical trade lanes and capital deployments across the global maritime network. We map the physical and monetary transmission mechanisms shaping institutional markets. Daily container vessel throughput via the Bab-el-Mandeb Strait declined 64% over a 24-month observation window, according to the UNTAD Review of Maritime Transport. This volume contraction reflects a systemic risk repricing by global ocean carriers, driven by altered security conditions along the Red Sea maritime corridor. Insurance markets have adjusted symmetrically, with war risk premiums for Red Sea transits surging by over 400%, as documented by the Lloyd's Market Association. The direct operational result is a systemic diversion of commercial tonnage away from the Suez Canal route, which historically handled 12% of global seaborne trade. The transmission mechanism functions through an immediate escalation of spot market freight assessments as carriers incorporate enhanced risk variables into basic freight pricing formulas. The long-term structural implication for Eastern Mediterranean transshipment hubs is a significant loss of operational volume, forcing a reorganization of regional feeder networks toward Western European ports. Concurrent restrictions across alternative choke points prevent the normal market optimization of trade flows. Data from the Panama Canal Authority reveals that severe draft restrictions, driven by meteorological anomalies, forced a reduction in daily vessel transits from 36 down to 22. Because the Panama Canal served as the primary alternative for Asia to U.S. East Coast traffic, its concurrent capacity reduction blocked the standard arbitrage routes typically utilized when Suez throughput stalls. Consequently, global container distribution networks faced multi-point capacity constraints, removing structural flexibility from the global supply chain. Institutional capital flows reflect this constraint, with multimodal transport operators shifting asset allocations toward West Coast rail linkages. The transmission mechanism converts maritime bottlenecks into landside infrastructure pressure, escalating intermodal freight rates across North America. The structural consequence is an elevated cost floor for cross-border intermediate goods, altering manufacturing supply chains that depend on synchronized components. Rerouting commercial liners around the Cape of Good Hope adds approximately 14 days to a standard Asia to Northern Europe transit leg, according to data from S&P Global and Clarkson's research. This geographic extension requires vessels to traverse an additional 3,500 nautical miles per voyage, disrupting established liner schedules. The operational cost extension is calculated at $2.3 million per full round-trip voyage, driven primarily by increased bunker fuel consumption and extended vessel hire durations. To maintain weekly departure frequencies on benchmark strings, ocean carriers must deploy additional vessels per loop, structurally absorbing excess capacity from the global fleet. The transmission mechanism alters vessel operating parameters, forcing ships to steam at higher velocities to minimize schedule delays, which increases fuel consumption non-linearly. The structural result for African bunkering ports like Durban and Port Louis is a sustained increase in fuel demand and port service revenues. This long-term trade diversion is restructuring maritime logistics infrastructure along the periphery of the African continent. Port infrastructure investments are shifting toward deep-water container berths and enhanced fueling facilities in sub-Saharan nodes to accommodate larger container vessels. Ocean carriers are signing long-term fuel procurement agreements at regional ports to hedge against localized supply shortages during peak transit periods. The transmission mechanism reallocates capital expenditure budgets from Mediterranean logistics hubs towards South African and West African coastal infrastructure. This asset redeployment reduces the operational efficiency of global logistics networks by tying up capital in fixed landside assets that require multi-year development cycles. The structural consequence is a higher capital expenditure baseline for global logistics firms, which reduces long-term corporate margin flexibility across the transportation sector. The global order book for new container vessels has expanded to its highest percentage level since 2008, with shipyard delivery slots fully sold through 2029, according to the Clarksons Shipbuilding Database. This spike in ordering activity represents an institutional response to artificial capacity destruction, as longer transit distances effectively remove millions of 20-foot equivalent units from active market circulation. Total global slot capacity utilization has moved toward 95%, creating a structural deficit in available empty containers at primary Asian manufacturing nodes. The transmission mechanism operates as extended transit times lock up equipment at sea for longer durations, preventing the timely return of empty units to exporting countries. The structural result for international manufacturing is an acute exposure to spot equipment availability, rendering long-term supply contracts subject to premium surcharge adjustments. The absorption of global fleet capacity has systematically altered the supply-demand balance within the charter market. Independent ship owners are securing multi-year charter agreements at elevated daily hire rates, as line operators scramble to secure tonnage to preserve loop integrity. This elevated fixed-cost environment locks in high operational expenses for carriers over a multi-year horizon, regardless of future spot freight rate trajectories. The transmission mechanism flows from the charter market into carrier balance sheets, increasing the fixed-cost portion of total voyage expenses. The structural consequence for global trade is a reduction in the price elasticity of container freight, ensuring that freight rates remain structurally higher than pre-diversion averages, even during periods of decelerating consumer demand. Freight cost pass-through to the European Producer Price Index operates on an approximate 90-day lag, according to an European Central Bank working paper. This mathematical relationship means that changes in ocean spot rates do not register immediately in consumer price data, but manifest as a delayed escalation in wholesale input costs. Manufacturing sectors characterized by low value-to-weight ratios, such as industrial chemicals and auto parts, show the highest sensitivity to these delayed freight cost imports. The transmission mechanism moves from ocean freight invoicing to corporate cost of goods sold ledgers, which ultimately forces adjustments in factory gate pricing. The structural result within the Eurozone is an upward pressure on core producer inflation metrics, complicating the monetary policy trajectory for central bank authorities tracking domestic price stability targets. As wholesale prices adjust, the second-round effects transition into consumer price index components. Retail firms operating on lean inventory models are forced to choose between absorbing elevated importing costs or adjusting end consumer prices upward to protect operating cash flows. Corporate financial disclosures indicate a broad compression in gross margins among mid-tier European retailers who lack the volume leverage to negotiate fixed-rate long-term contracts with major ocean carriers. The transmission mechanism bypasses short-term hedges as existing annual freight contracts expire and renew at higher market clearings. The structural consequence is a persistent inflation tailwind across non-energy industrial goods, sustaining elevated consumer price index baselines across major developed economies. The reduction in Suez Canal traffic has generated a corresponding shift in state revenue profiles across the eastern Mediterranean region. Suez Canal Authority revenues fell sharply, directly impacting Egypt's primary source of foreign currency inflows and stressing the state's balance of payments. Concurrently, maritime traffic data indicates an increase in strategic leverage for states managing alternative infrastructure nodes along the Circum-African route. The transmission mechanism functions as the physical redirect of trade flows, transfers bunkering, logistics, and maritime servicing demand to distinct sovereign jurisdictions. The structural consequence is an asymmetric reallocation of regional financial power, altering the risk premium assigned to sovereign debt issuances across affected developing nations. This geographical friction accelerates the development of continental trade corridors designed to bypass maritime transit entirely. Cross-border capital allocations are increasingly targeting Eurasian rail links and domestic infrastructure networks that offer alternative routes between manufacturing centers and consumer markets. Tonnage carried via land-based container rail lines across Central Asia has shown sustained incremental growth since the onset of maritime transit extensions around the Cape. The transmission mechanism operates as shippers switch freight modalities to avoid extended ocean transit timelines and volatile spot surcharges. The structural result is a permanent diversification of supply networks, reducing the long-term dependency of global trade on singular maritime choke points. The permanent structural reallocation of global maritime assets around the Cape of Good Hope establishes a higher baseline for international transportation costs. Long-term corporate capital deployment is adjusting to extended transit timelines, requiring larger working capital allocations to finance elevated inventory volumes in transit. Ocean carriers are committed to extensive fleet expansions through 2029, locking in structural capital allocations based on the presumption of prolonged route diversions. The logical structural endpoint is a fragmented global logistics network, where geographic distance has been permanently repriced into the cost structure of international trade, altering the margin profiles of manufacturing and retail sectors globally. This analysis was produced by Macro Frontier. Subscribe for structural macroeconomic intelligence published bi-weekly. The data does not care whether you are watching.